What are easy ways to calculate retirement taxes? Imagine sitting down with your coffee, looking at your retirement income, and knowing exactly how much of it will go to taxes. Sounds good, right? Calculating retirement taxes might seem tricky, but there are simple ways to get a clear picture. First, start by knowing what types of income you receive. Common sources include Social Security benefits, pensions, annuities, and withdrawals from retirement accounts like individual retirement accounts and 401(k) plans. Each source can be taxed differently, so understanding this is the first step. Next, use the tools provided by the Internal Revenue Service. They offer specific worksheets and methods to figure out how much of your retirement income is taxable. For annuities, you can choose between the simplified method or the general rule. The simplified method works if your payments started after 1996 from qualified plans. It involves dividing your after-tax contributions by the total expected payments to find the tax-free part. The general rule uses IRS life expectancy tables to separate taxable and tax-free amounts, especially for non-qualified plans. These methods help you see exactly what portion of your payments is taxable. Estimating taxes on Social Security benefits is also straightforward. Your benefits may be taxed partially depending on your combined income, which includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits. The IRS offers calculators and estimators online that can help you see how much of your benefits might be taxed. Using these tools can prevent surprises when tax season arrives. Another simple approach is to use the IRS Tax Withholding Estimator. This free online tool asks about your income, filing status, and deductions. It then recommends how much tax to withhold from your pension payments and Social Security benefits. If you find that too much or too little is being withheld, you can easily adjust it using the forms the tool provides. If your income stays consistent from year to year, you can also consider using last year's tax amount as a guide. For example, if your adjusted gross income was under $150,000, you might withhold the same amount this year. If it was higher, you might want to withhold about 110% of last year's tax. This simple rule helps you avoid recalculating every year and keeps your planning steady. Using tax preparation software like TurboTax can make the process even easier. These programs allow you to input your income sources and withholding amounts, then automatically calculate your estimated tax liability. This way, you can see how much you owe and make adjustments before tax time. Understanding the difference between your marginal and average tax rates can also help you plan better. Your marginal tax rate is the rate on your last dollar of income, while your average rate is your total tax divided by your total income. For example, withdrawing money from an individual retirement account might push you into a higher tax bracket, increasing the tax on additional income. To keep your retirement budget on track, regularly estimate your tax liability using these methods. Adjust your withdrawals and withholding if needed. Doing this can help you avoid unexpected tax bills and make sure your money lasts longer. Starting with IRS tools and simple rules like using last year's tax as a baseline makes the process manageable. It helps you stay in control of your finances and enjoy your retirement with peace of mind.